Well, the fallout of the pandemic continues to surprise us in a myriad of ways, and one that is starting to have major implications for the property market is the rising cost of building materials. Who will this hurt the most?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent, co-host of Foxtel's Location Australia, and author of Auction Ready.
And I'm Chris Bates, mortgage broker. Before we get started, I need to let you know that nothing we say on here can be taken as personal advice. We always recommend you engage the services of a professional.
Don't forget that you can access the transcript for this episode on the website, as well as download our free full or forecaster report, Which Experts Can You Trust to Get It Right? theelephantintheroom.com.au.
Today we're joined by Mike Mortlock of MCG Quantity Surveyors, and Mike is an industry leader in tax depreciation, knows the cost of building inside out, and is a bit of a data geek to boot. We've seen you before on this podcast, I think episode 128, and as one half of the Trolls in December 2021. It's nice to see you again, Mike, and you're with your serious hat on today.
Yeah, well, as much as I've got one, we'll give it a red hot go. Thanks for inviting me back.
Mike, good to chat. It is a serious topic, to be honest, because we're seeing this play out with a lot of our clients. We've got clients who want to buy houses, who have bought houses that want to do renovations, and they can't get, building quotes, and can't even get the numbers. You've got clients who are mid-construction. We've had clients with builders have walked away from them mid-construction, and builders have gone bust. So it's a huge issue out there. I mean, can you give our listeners a bit of an understanding of, I guess the big issues at a macro level in terms of supply, but then also on a micro level in different cities where, labour shortages, etc. What are you seeing out there?
Yeah, look, there's a lot of moving parts to it, and it's affecting people in various levels for various reasons. I mean, if you think about when the pandemic started, you've got the issue of people not being able to go overseas and do their annual skiing trip in Aspen. I've just been reading your diary, Veronica. So they've obviously got this surplus money, and they're sitting around their house going, you know what, I really hate this place. Let's do something to it. So for me, that was kind of really the start of the shortage of tradies, because they're so busy. And then we had builders that were actually worried about activity during the pandemic, that were really competing each other to sign up building contracts. And then, of course, they get to the point where these are fixed price contracts. The materials are so crazy that they're actually walking away from the deals, and some of them going under. So on the small, to start off with, there was a huge increase in renovation activity. But the real kind of macro problem is just the availability of materials. You think about the timber mills that might have, a big workforce that have just shut down, or they might have minimum staff. I mean, with the restrictions to construction work on site, we do a lot of progress claims for financiers, and they might have a limit that they can only have 5 people on that site for a particular point in time, and really that just shuts the whole thing down. So there's a myriad of factors that are leading to these construction cost price increases. Labour is definitely one of them. There's not enough tradies out there, not enough builders to take on the work, but materials has been the big one.
So is it just an Australian issue, or is the world renovating and the world building homes through the pandemic?
It's a good question. I don't have the data on renovation across the globe. I would assume that they would be sort of having a similar situation there, but certainly materials. I mean, a lot of the materials are coming from a variety of different countries, depending on whether it's timber or concrete or just even, prefabricated sort of cabinetry stuff. There's a global problem with materials.
Do you think it's a supply of that material, as in like they can't produce the same quantity as they were producing before, or it's just literally a demand problem? They can't make enough of it because all the world's wanting more timber or concrete or steel or etc.
Yeah, we were talking to a timber truss company not that long ago, and they basically said we could run 24 hours a day with our workforce and still not keep up with demand. And then the question is, okay, well, why don't you ramp up the production, get the people in the door, make it happen? He said, well, we can't get the materials. So there's so much demand that can't be met by the materials not being available.
Is this all sort of kicked along initially by the federal government's, home builder
Yep.
stimulation? Is this sort of like the whole snowball effect that unanticipated consequences?
Who'd have thought of policy decisions being made in Canberra and then the real world implications have some unintended consequences? We haven't seen that before.
Well, the irony of it all is that at the moment you've got so yes, you had this profitless boom, I've read, because builders are not making profits because they've gone fixed price contracts, and so they're doing all this work, they're busier than ever, but when they look at their takeaway, because the costs and the labours have gone up, they're not making any money on these, and they underpriced them because they were so desperate to get work at the start of the pandemic as well. So, I mean, then you've got builders going bust, and then you've also got builders that are unwilling to sort of do deals now because they're unsure about materials. So we're going to see this, ramp up in, more housing and units, etc. And then this real depression where there's not many builders left in terms of the number, or not many people willing to take on work because they're so concerned that they're going to lose money on it and go under. So what we built in those years is going to be a shortfall over the next few years. So what do you think about that?
Yeah, that's very possible. Take, for example, we were talking to a company that does pools, mostly residential style stuff, and they've got orders through to 2023. And because they're not sure of what's going to happen with materials, people are signing contracts on these pools with no actual indicated price. So people are kind of saying, I just want a damn pool. Yeah, if it goes up 60% on what it is now, I'm prepared to pay it because these people are just booked out so far. So if you've got the money, everything's going to be okay. Hasn't that always been the case, right? But people are just paying a premium, and it's just got to that point where, the people that can afford it are the ones that get it. I mean, the Sydney housing market is the same, right? You've got so much emotional buying out there, and people are saying to their buyers agents, as I'm sure you would know, Veronica, that I don't care what it costs, I just get it, I want it, right?
Not my clients.
Not yours. You educate them.
All my clients care what it costs. There's still a budget, and for every one of those people pushing the price up, there's a whole bunch of other people that do have to care about what it costs. I was talking to my architect the other day, and he was saying that insulation has gone up 30%.
Yeah.
And he said, if you can get it, that is. So if you can get it, it's 30% than what you priced it into the deal. So no wonder builders are under real pressure even if they haven't cut their price to get the deal or to get the build in the first place. Fixed price contract, it's all wonderful when you've got a fairly constrained, supply market for materials. But, and it's hard because nobody will want to sign a fixed price contract anymore. And like you're saying there, people are prepared to sign a contract with no price on it, which is pretty impressive. I can't see many people when they're renovating their homes, mainly because, it's so expensive anyway. But also in a heated property market where you're paying big dollars to buy the property in the first place, if you bought to then renovate, that is, then there's going to be some real pressure coming on. But I also think just trying to sign a contract with a builder without having any, without any prices on it effectively, that's just open-ended. No one has access to money. Well, very few people have access to money that is so unfettered.
Yeah.
You know what I mean? Like, what's this going to mean? Is it going to mean that people leave the industry like you're suggesting there, Chris, and then there's going to be no builders? Is it going to mean that how is this going to roll out, I wonder?
Yeah, like pools are, I suppose, a smaller ticket item than a whole house, right? So we're not likely to see people signing a contract with, no price on it. But what we might see is a lot of builders wanting to go to cost plus contracts, where they're basically saying, look, we're going to charge you a margin on the labour and materials. So that way, as materials go up, then that's sort of priced in and it's passed on to the consumer. Now, typically, that's not a normal sort of residential construction contract unless, say, someone is not sure, they don't have all the documentation, the design squared away. They want to be able to make changes as they go. It's quite an expensive way to build to be able to do that, but it prices in, the ability to be flexible and change things, which, does cost the builder. But you think about a lot of these builders that, in the residential space might be working on an 8% margin. You've got insulation going up 30%, and probably the worst example is timber, where there was up to a 70% increase on timber costs. An 8% margin, there's not a lot of fat in materials to be out to be fluctuating.
See, 8%. So if you're doing $100 million build or $1 billion build, it's not that much money they make really once things start blowing out. I mean, we saw Pro Build go under, and they're pretty big. I'm not sure if they're privately owned or not, but they're a pretty big builder in Australia, right? I think they've got how many billion of projects going on, Mike? Do you know much about them?
Yeah, look, they were South African backed as far as I understand. They have, don't quote me on this, but I think there was around about 500 employees, which is not a tremendous amount, but the network of subcontractors is likely sort of 5 times that, right? So a lot of these big companies, they have people to run them, but the people that are doing the construction are all sort of trickled down subcontractors, and that's where you see the issues of people running in to grab their tools before the site's locked up, right? Like not only is it making sure they get the tools, but if you are let's say a small to medium sized painter or cabinet maker, you might be kind of thinking, look, this is a big business. I'm in with those guys, so I'm going to just kind of not worry about diversification. And they owe me $500,000, but they're pretty good for it after 90 to 120 days, and now it's the concern about the cents on the dollar. I don't know the specifics about Pro Build and how much subbies could potentially be hung out to dry, but you see it quite often.
Yeah.
Do you think that developers right now would be got the guts to go and sell things at certain prices? Because you're talking. Yeah, we'll build. I mean, you might have to get 30% of the building sold before you can go and get development finance. But
I see what you mean.
Got it. And they're like, well, if I sell it for $1 million, I make 8% margin. But if my costs go up, then I make nothing. Or maybe I've got to get a bigger margin, so I've got to try to sell them at 1.1 and just to protect myself. And I don't know, if I was a developer, you'd have to have pretty gutsy and a lot of cash in the bank to go against the material potential future rises. And would you just focus on land banking now? I've been sort of tracking a few things and can see that developers have been still out there buying, greenfielder sites and, city sites for apartments, etc. I just wonder whether we're going to see this real lull in builders saying, well, we're just going to play until we know things start leveling off and we know what timber costs are going to be when we build. We're not going to sort of take that risk because the margins are just so tight. Yeah,
I mean, it makes sense. The world is sort of getting back to normal, so it's not likely to last forever. But it's a bit like we heard the stories about places like Harvey Norman making the punt that the pandemic's happening, we're going to order unprecedented amount of stock because we're sort of hedging our bets that this stuff's going to walk off the shelves, and they obviously made a killing on that. We've seen quite a lot of builders actually sort of stockpile materials, and even builders going to Bunnings and ripping the shelves off the timber. I'm doing some landscaping at the moment, and I couldn't get any timber posts the other day, which is great. I got my weekends back, and I'll do it eventually. But it's one of those things. The developers, I think, the builders that have got that kind of stock, then that's great. But they can only sort of store it and look after it for so long. Yeah. That 8% margin is more based on the cookie cutter style home builders that are building the same sort of stuff. The margins would be bigger on some of the boutique stuff, but I guess it depends who the client is and how the contract's structured. But I'd be nervous going into these developments with what has happened, and how long is it going to take for things to get back to normal? I'm not sure. There's a lot of pent up demand.
And building costs over time, have they generally risen quite sustainably, 3-4% a year, or and do they go back down in sort of price? I mean, once building costs, rise, do they just stay there, because, and so we might get this new, floor in terms of what it's going to cost to build a home per square metre, and then they don't want to go back to the days when it was, much tighter margins.
They do go up and down, and this is where Veronica did warn people that I'm a bit of a data nerd. You can look at the building price indices over the years, and that's how depreciation guys like myself calculate how much it was to build something in, say, 1989 compared to today.
Yep.
It's indexed on a monthly basis. Typically, it's always sort of been around CPI plus 1% as a year-on-year increase, so it has been fairly flat, but there were periods where it definitely spiked and periods where it dropped off. I mean, you think about if you look at the building price indices and see how they move, you can actually track things like union activity and cyclones. Like if there's a cyclone in Queensland, you see timber prices go up. If there's a increase in union activity in CBD sort of building markets, you see labour prices go up. So, no, to answer your question, This is the craziest increase that I've ever seen in my career, and I assume that probably would be the same case for anyone that's alive and much older than me. It's going to be the same. They're normally pretty stable.
So what's the index then currently? I mean, if it goes up if you measure it monthly, what's the figures?
Be good if I had that data. This is the trouble when you say we're talking about the rental loss index and then we're going to construction data. I can furnish you with that. I'm not sure exactly when the last one has been released. We're sort of ticking onto a new month, and they tend to be a little bit delayed. And the building price index is also a little bit unusual that it comes from Department of Foreign Affairs, and it's looking at more government works rather than, say, residential stuff. So places like the HIA are probably plugged in a little bit better than me in that, and that's where we're seeing more of the data about the increase of materials compared to one another, like the timber and the insulation and that sort of stuff. But yes, I can get that to you.
I'll have a look at that data when you do get it. But I mean, you mentioned before about cost plus contracts. I mean, that's fine if you're doing a bathroom, or you're doing your kitchen, or maybe you're changing windows or flooring, and things that maybe you can fund from cash, or you can, cosmetic things that you can sort of fund from equity, I guess, that isn't going to break the bank. But, if you wanted to do extensions and add floors and, or even a knockdown rebuild, etc., this is where, you're going to have to go to a bank most of the time, because people can't get access to that equity. They just haven't got that much. Banks won't give it to them if they know it's for a build, for example. And they're going to have to need a fixed price contract. But banks are very scared of cost plus at the moment. Before, it was a case by case basis. If you could sort of show the complexity why it had to be, maybe it was a really big build, maybe they've got other mitigating factors in terms of other assets, and you could really sell it to the bank why they should still take it as a cost plus. But at the moment, it's literally a blanket no, because they know that could be anything. They have no idea what the labour cost is going to be or the material cost. So it's sort of like, it should be a great time for builders, I feel, because we've seen as house prices rise a lot, people can't afford to upgrade. They can't, not just the bigger mortgage they've got to take on, but then you've got stamp duty costs is increased, selling costs, etc. So they're going to get stuck in their house, I guess. They can't afford to upgrade. They don't want to leave the suburbs. So they get forced to renovate, but then they go and can't get a fixed price contract. So they're sort of stuck. They can't renovate, they can't upgrade. And it's a real tricky thing for people at the moment, because so then they go look to do cosmetic things, but a lot of cosmetic things you don't want to do until you've done your structural things. So you're going to redo work. So, I mean, what sort of, do you think that building materials will sort of go back to sort of prices in the next 12, 18 months? Is there anything you're sort of hearing where, things are starting to get better, or do you really think this will play out for a few more years, especially with things that, in the Russian world that's happening at the moment?
Yeah, I mean, that's pretty crazy what's going on over there.
But how many building materials come from the Ukraine?
Well,
is it a big supplier of anything particular?
They've got all sorts of weird stuff like platinum and some precious metals like that. In terms of nuts and bolts building materials, I couldn't tell you exactly what an impact Ukraine in isolation would have. I think there's obviously a huge amount of value in that country from Putin's eyes, right?
Yes.
And I mean, this is kind of a weird situation where we've got people fleeing Kiev, turning up, at probably refugee camps and saying, like, where do I park? We're used to people fleeing war zones, on foot in poverty, but there's obviously wealth in the Ukraine. It's pretty terrible what's going on there. But to answer your question, I think it's got a little while to play out. I think the timber mills and things like that, they're back up and running. The economies need to get back and moving, but it's going to take a little while for things to settle down. And cost plus contracts, there's an inbuilt kind of conflict in that. There's no incentive for the builder to finish in a hurry or to source materials in a cheap way. So they're not a very popular way to build. And I think it could and it should be a good time for builders if people are prepared to pay the increase in the materials. It's just the competition at the beginning of the pandemic where they were kind of worried that there might not be any activity at all, and they're fighting over one another and fighting each other on margins. And then the fixed price contracts where they're having to absorb these materials costs, there's a number of them that have gone bankrupt, and ProBuild might not necessarily be the last. But, there's also situations where natural disasters are actually taking the labour force away. I mean, even before the situation now in northern New South Wales and southeast Queensland, I was talking to one of the top, they would probably be top 5 builders in Australia, and they were saying that they can't get roofers because of the cyclones. The insurance companies were just paying them double, and these were roofers that were prepared to say, no thanks to what would be a very cushy sort of supply of work over the long time. They would be, not having to worry about getting work for the next little while, but they're chasing the dollars and doing the insurance work. And I think that's going to be a big problem in Queensland with the insurance stuff. I mean, obviously there's the issues with flood cover, and is that capped, and have people opt out, or was it not included? Then we've got to try and find this labour force to come and do the rectification works when everything's already stressed from a labour availability and material shortage point of view. I really feel for the people suffering from that at the moment.
Well, let's remember, though, that the people in the south coast of New South Wales from the bushfires,
absolutely.
19 and 20, there's people still down there living in caravans because they can't get builders to build.
Yep.
They haven't got enough supply. So, they're out of anybody, they're the worst off because they've been waiting the longest, and B, who would have thought this would happen in terms of costs?
I mean, it's very true, actually, because the time you actually recover from the traumatic event and start thinking maybe we should rebuild the house, and then you sort of get the money from insurance and you start getting designs and lock in a builder, it could take you, a good 12, 18 months, right? And that's where we are today almost, it's sort of mid last year. And when we were down Bateman's Bay in January, and there's literally, you could see house after house getting built down there. So, it takes years down the line. So, it's a sort of a big problem that's built. Is there a bit of a premium, though, on builds versus your postcodes when you're doing your analysis of what it's going to cost? Is there like a Mossman factor, you know what I mean, in terms of, it's much more expensive to build the exact same house in Mossman as it is in Mollymook or another M place, Mildura?
Yeah. I think it's a bit like going and buying a cake and say, can I have a celebration cake instead of, say, a wedding cake, right? One costs double. You think of places like Mossman, a lot of the builders, they kind of think, well, this person can afford to pay for it, but it's also potentially a pain in the backside with site access if they're doing bigger works as well. So there are actually some additional costs. And you think about, the tradies, are they wanting to work in Mossman on the smaller jobs or go elsewhere where, that it's not necessarily the premium stuff that they're doing? So yes, that is a factor. And then when you take that on a larger scale, it costs more to build in, say, Cairns than it does in Brisbane, just because you've got to have, the labour force there, you've got to move the materials and that sort of stuff. So, There are, of course, the building price indices which track the costs over time, but there's also regional indices that tend to stay a little bit more flat, where it just costs that extra percentage more to build. Even, say, from Newcastle to Sydney, there's a couple of % difference.
Will migration solve our labour problems? Because, a lot of people say that, but, skilled labour, does that qualify? I don't think it does. If you're a chippy or an electrician, I don't think you can get a 457 or whatever the skilled migrant visa is. I forget the code.
Yep.
But I mean, tourists, those sort of backpackers coming here for a year, maybe they do a bit of labouring, etc. So maybe we get that sort of, people visiting for a couple of years, but that may not come, straight away. So will migration solve this in the short term in terms of giving us a lot of new labour?
It definitely could. I mean, I'm sort of thinking back to building sites I've been in Melbourne in the last couple of years, and you would see complete trades just being owned by a certain nationality. Like it might be a bunch of Afghani tilers, and you say to the builder, like, what's going on with just Afghans doing the tiling? I don't know, they just came out of somewhere and they're pretty good at it and they don't complain, so they've got the work, sort of thing. So yeah, I think that is part of the solution, and then it's just a matter of the materials. But yeah, I think if we're opening the borders, we can't really sort of service the things that need to be done at the moment. I mean, you talk to anyone in hospitality that's trying to get people to wait tables or something, that's always been something traditionally that has been done by the backpackers or the international students picking up those jobs.
I guess, COVID has been interesting for so many ways. I mean, there's so many changes that have happened in our society and in the way we operate, that have been accelerated, like a decade's worth of change that's happened in a year. And it's also put a spotlight on a lot of things, like the hospitality worker situation. There's been a lot of noise around the 457 visas, because that was taken away from them, wasn't it, some years back. And I guess, if you're not in hospitality, you don't pay too much attention to it. If you can go to your cafe and get served and you can go and have a meal and all the rest of it, but then all of a sudden you can't. But also, I think it's been interesting to watch, our rollout coming out of lockdown mentality into living with COVID. And if you think back to our episode with Brendan Coates back in last year, was 195, I think it was, and we were talking about the plan, the unlocking plan, and are they being completely truthful with us? And I suspect not now, because you look back and you think, we're now living with COVID to the point that I think I read somewhere that even if you have COVID, it's no longer required that you stay at home. It's recommended.
Yeah, right.
You know what I mean? It's like, like I was talking to my sister. She lives in Italy, and of course, I can't believe my family over there have not had COVID. It's a miracle. But she was saying her little boy, Tommy, is 11. And in his class, basically there's always a kid with COVID, so the whole class has to isolate. But now it's down to, only 5 kids needs to isolate. So the whole idea of us living with COVID and just getting on with it is, we're just going to be sick, all of us are going to be sick all the time. But we'll be still at work. And I think that as opposed to what happened over December, when we had these massive, knock-on effects, supply chains in the supermarkets, very visible to all of us in terms of what actually happens when people are home sick. Is this, once we're back at work and once we've got migrants here and once we don't care about getting COVID anymore and hopefully no new strain comes that's worse than any of the other strains, all that sort of stuff, can we go back to normal, do you think, in this regard? With and I'm talking about, I know that you probably go, well, I'm not an expert supply chain expert in the building market, but is there any precedent for, I know that the rises have been unprecedented, but is there any precedent for once all the factors go back to normal, if there's a normal, that we just see it level off again and go back to normal?
If you like what you're hearing here, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars, please. Every review helps make it easier for other people to find us and hear what our amazing guests have to say. We love hearing your questions and we're planning more listener Q&A episodes. Please send your questions in. You can send them via the website, which is theelephantintheroom.com.au, or directly via email to questions@theelephantintheroom.com.au.
It's a big question, Veronica.
I'm sorry about that.
And no, that's all right. I'll do my best. I think there's a lot of kind of forced experiments going on with COVID at the moment. From the little things like, are we all going to be on Zoom as much in a year's time? Like I was talking to 2 different cab drivers in the CBD of Sydney just last week, and they both sort of said, 2 weeks ago, the people started coming back. One said that they thought about 70% of people were back. The other one said 45%. So a greater sample size would hopefully cut that down a little bit. But yeah, I guess it remains to be seen. I think the COVID situation has been a forced experiment for all of us to see, can we run our business without necessarily catching up with people? Can we send our employees home? Can we work at home from with employees and, perhaps educate our children? Thankfully, haven't had to worry about that myself. So yeah, look, I think we're going to get back to a level of normality, but we're probably going to find that there are changes that happen. Some for good, perhaps not all of them, but I think probably the majority of things that we've adopted with COVID are going to stick around. And building prices, that they've got to equal out at some point, right? Like there's a huge demand for these materials, so that that timber trust company that's saying like, we need the stuff because we've got the orders, we're ready to go. Obviously they're going to be demanding that stuff, and the suppliers are going, okay, well, this is boom times for us. Let's get it out there. And there might be that sort of short-term gold rush where they're making a fair bit of money, and maybe developers and tradies and that sort of thing are all the same. It's a great time to be a tradie in Australia. There's so much work going out there, and sometimes I think like if I was to run my business the way I've had interactions with tradies, I'd be bankrupt, right? They say, I'll call you, I'll be there on Wednesday at 7, and nobody shows up, and then they don't answer their phone, and you have to talk to 4 or 5 other ones. It's I don't think it's necessarily because they don't care. It's just they don't need to care. There's so many opportunities out there for them.
Yeah. I mean, it's not just residential, right? We're talking commercial, we're talking industrial, we're talking infrastructure, government projects, all over the world, that are demanding materials. Low interest rates are encouraging people to sort of invest in projects, and governments to stimulate their economies, etc. So it is a bit of a perfect storm in terms of this real push for demand and, to get out of this sort of pandemic when, to push the countries forward. I do think the lockdown thing was actually a really big issue. I was talking to a client who's in a construction company, and the issues they had tracking their staff, where they were they isolating, were they not, who was on site, who wasn't, and them trying to talk to each other and shutting down sites and, getting penalties if you're late, and who's liable for that? Is it the government or is it the builder? And and it was a really tough time. He said that for the business, because they just didn't know what was happening. Everything was just stalling and nothing was moving forward. And so hopefully those lockdown things, like you said, Veronica, maybe we won't see those lockdowns again. If the building materials start to get a bit more normality, and then labour starts to sort of flatline a little bit more with migration, and maybe people are, not getting as many people willing to sort of sign contracts, etc. So, maybe in a couple of years it starts to really level off.
I tell you what is interesting though, is that it just shows how the whole building industry still relies on human beings to do the work. You can do prefab all you like. At the end of the day, and throughout the whole supply chain, by the sounds of it, there's very, very high touch industry. So I think that's sort of probably an interesting thing. A lot of people are talking about automating to be a solution to things, and certainly there's been some structural change to businesses, such as the use of Zoom. And I know I use so much more Zoom and Google Meet now. I didn't like using it before. Now I prefer using it.
Yeah, so because it's inefficient, right? Like,
I know.
If you sort of think, I probably should have known that was a meeting that never was going to go anywhere, but you might have driven 20 minutes and bought a coffee, and then you're having to sort of be polite because you can't really sort of shut it off after 5 minutes, and you're just kind of hanging out there, right? Or maybe you should be. I don't know, Veronica. You probably just say I'm out of here.
No, I'm much more polite than that. That I used to be in recruitment years ago, and I had a rule that you had to give a candidate half an hour.
Yeah.
even though it was just a decency rule, my personal rule. But there were
That's nice.
consultants that I worked with that were basically in and out in 5 minutes. So.
Yeah, I've had some shocking 29-minute interviews before. No, you're right. These are human beings after all. You got to do right by people. But I think there's a lot of inefficiency built into organisations and people, right? And COVID has kind of forced people to look at new ways of doing things. Take, for example, where I live, there's not a lot of takeaway choices, right? Or at least there wasn't. But then COVID happens. My favourite little Thai place that was just kind of like, we're not doing delivery. Get out of here. Come here if you want to eat. They're like, now delivering. And that's sort of stayed. So, there's a lot more serious about COVID than me getting delivered Thai, of course. People have lost their lives and that sort of thing. But it just sort of goes to show that people have been forced to kind of look at the ways that they do business, look for other ways to transact, other ways to survive. And I think that is a net positive for a lot of businesses. But it is very hard when you say to entire industries, you can't trade, you can't do anything. So we will have lost a lot of businesses, and people will have lost their livelihoods. There's probably a lot more people at the moment that have made money because there has been almost like a post-pandemic boom for a lot of people. But yeah, we've lost some good businesses, and a lot of those sort of smaller coffee shops and things like that unfortunately aren't around anymore.
I think for the builders right now, though, they should be having a pretty good time of it, because you've got sort of, as prices get more expensive and investors are back, and this is being even though we encourage our investors to go nowhere near new property, but a lot of investors do for those depreciation benefits that Mike knows all about. But, they should be, investors are back, in terms of numbers. We can definitely see clients asking us, they're thinking, well, I can't upgrade, well, I'm just going to buy an investment property. Or I should have done it 2 years ago. Investors always come late to the party. They want to see what happened last year and go, oh, wait, I should have done something. And then they get in late in stock markets and property. So we're definitely seeing more and more clients come to us and saying, I want to buy an investment property. So new property should be selling. You should be able to, off the plan sort of spruikers should be having a good day right now because investors are back. First home buyers and frustrated because they've really missed out on the market in the last couple of years, and they're also encouraged with low interest rates. So they should be out in the market trying to buy apartments. But unfortunately then you've got developers saying, well, I've got the site, but I don't know how much it's going to cost me to build, so I haven't got the guts to go and build it. And so it should be this real boom of building. And, I've looked at some stats and we've just underbuilt so many. We've got a rental crisis, for example. Yeah. Well, that's because we haven't got enough housing or, apartments or across the whole country. And so we need to be building a certain amount per year. And I do think this is only going to make it worse, because over the next few years, then we're going to add in migration, more demand, less supply. And these issues aren't going to sort of evaporate. But, yes, I do feel for the builders at the moment. And also had all the building quality issues. That really was quite prolific. I think a lot of our clients became educated around that and have sort of read the papers, and it's been in the reports, and they've heard bad stories. And so they're more aware of issues like that. So they're not, that's really hurt buildings over the last few years as well. I think it might be good to do another segue into the rental loss index, which we were meant to talk about today, but I changed the topic. What have you been working on there, Mike, and why is it interesting?
Well, what I think is interesting in the rest of the world, sometimes there's a discord, but we'll see how we go, right? So, everyone's familiar with vacancy rates, and they've obviously been in the news a lot. And as you say, the COVID situation has led us to a rental crisis on top of a lot of things, right? Investors we're on 20-year lows of activities. We've had a lot of changes, particularly in Victoria, with residential tenancies making it harder. Even in Queensland, they're talking about adjustments to the land tax situation there that's disincentivising investors. And there's a lot of investors that have sold their properties as well. So we've had some real issues there. The rental loss index, I think, had a lot more value when it started than it does today, right? Because there's not a lot of rental losses. So what we're looking at is rental properties that are on the market for 21 days or more without a tenant, right? So we're calling them kind of delinquent rentals. So we're calculating how many of those there are in a particular suburb compared to the normal pool of rental properties in that area. And then we're looking at the median rents for houses and units, and then we're doing like a stratified mean of that. So we're looking at if there's 90% units that are renting for 400 and there's 10% houses that are renting at 600, then we get an average for that. So the two things it's telling us is what is the average loss due to rental vacancies for investors in a certain suburb, and then what is the total loss due to vacant properties in a suburb. So one's sort of more about the concentration of investment properties that are not being rented out, and the other one is more of a, well, investors in this suburb are losing on average X amount. And the story has been really about the inner city markets and those markets around universities where you had those 1 and 2 bedroom apartments. So a lot of places, like South Yarra and South Bank, like Melbourne was dominating the list for a long time, where we saw, of course, high vacancy rates, but just a huge amount of rental stock where international students had disappeared. The Airbnb market kind of disappeared because people couldn't do that, and those properties went back onto the private rental stock. So the rental loss index for me was just really designed to help investors as part of their kind of due diligence. Am I buying in an area that's got a high rental loss index?
So if you look at vacancy rate as basically, what percentages of existing investment stock is available at any given time.
Yep.
And there's that replacement rate as well. It needs to be it's got to be above 1%, isn't it? Because there's that 1% which is for churn, allows for churn.
Yep.
And so I guess what you're doing is putting a dollar figure to it, and then trying to rank these places, right? Because I was actually a bit surprised. I did look at your website, which will pop the link in the show notes, and I know not every suburb's in there, but there was quite a lot that. So if it had a 0, is that because there is nobody losing money? No properties are on the market for rent for over 21 days. Is that what that means?
Yeah. So normally it's a decile index ranking from 1 to 10, but you can also go and search your suburb and see what the rental losses are. So often there are suburbs where there are no vacancies, so there are no rental losses. But we're trying to sort of rank it from 1 to 10, and 10 is not the same as 10, say in November, right? Because the rental losses have shrunk so much. The really 10 is just saying you're in the top percentile. But I never thought I'd say this, but buying an investment property in an area that's currently ranked 10 is not necessarily a disaster right now. Back last year in, say, October, November, it probably was, but there are still pockets where investors aren't necessarily renting out their properties, and they tend to be in and around hospitals and universities, or they'll be those greenfield house and land style areas where properties are coming on hard and fast.
I mean, it makes sense though, but a lot of common sense to investors, they don't think it through, right? So, if you're going to buy an apartment in a high rise sort of heaven or hell place where there's a lot of for rent, a lot of people don't just do the search. They go, what are they going to buy it for? But then they go, well, how many other places are rent? And you can see there's 400 in Rosebery in Sydney, and add in Waterloo and Alexandria, and there's 1,000 2-bedroom apartments for rent. They all look the same. So common sense should say that, it's not a great investment to either sell or to rent, but people still do it. The greenfields also make a lot of sense as well. People making those compromises to move out to these suburbs, they're doing it because they, want to live there long term. They don't want to move there just to rent. They're doing that because they want to own a house. And so they don't. That's another big problem with the people aren't willing to move out there just to rent something. They're only going to move out there if they buy. So what are some of the things that came out with the rental loss index that surprised you, I guess? Because, I guess they're the things that are naturally going to gravitate to the top, where you're going to see a lot of vacancy because there's limited demand and lots of supply.
Yeah. Well, I guess I was surprised at just how strong Melbourne sort of CBD unit markets were for rental losses. And what I kind of like about the index is, like, you can have a vacancy rate, but a vacant property in one suburb might cost you $300 a week, in another it could be $1,300, quite easily. So this is where putting a dollar value can really sort of show the investor, okay, well, a vacant property in this suburb is actually a lot more painful cash flow wise than another one. But the big thing for me was like Box Hill in Victoria. So when we first put this index together, I kind of thought, like, my only idea, a bit like starting a podcast, is I wanted to help investors make sure they weren't making bad decisions. So we did this index, we got a little bit of media, and I shared the data, and then the journalists, and you can't blame them, said, well, why? Why is Box Hill? And I didn't have the answers, right? So I had to lean on people in the industry and people that knew the area to say, well, what is going on? And the big one, the big correlation was universities. So as you say, it's really obvious in those kind of high-rise markets where there's just so much competition. A place is up for rent and you've got 82 bedroom units in the same building that's the same. That's not going to push the prices up. But I didn't realise how much of a problem there was around the university. So you guys probably know better than me what the uni is around Box Hill. I can't remember.
This is Box Hill, Victoria, right?
Box Hill,
Not
Victoria. Yeah.
Well, I mean, that is a high-rise development. This is like a little, if you're on a plane, you'd be like, what the hell is this? It's like 50, 60-story buildings in the middle of nowhere. That's no offense to anyone who lives around there, but it was literally, it just doesn't make sense. I have a friend who was he's been on the podcast, Cameron McQueen, back along episodes. That was his office. I went and saw him there, and I was just like, wow, they're building this high in this location. So I do think it's a density issue. It also has a certain, community there, I guess, in terms of, and a lot of migration probably would flow to that area. So I think the migration numbers have smashed it. Then I think you've got a lot of overseas students that are a certain nationality as well, would smash it as well. So you see a lot of new supply, a lot of investors, a lot of foreign investors as well, which was the previous boom of the 2015, 2016. That's why they were selling it a lot to the Chinese community. And so it doesn't surprise me that you've got huge vacancy and very little demand, especially if you can't rent it to uni students or new migrants. So any other sort of pockets that really where investors are really losing a lot of money, because this isn't money that they're losing, in terms of capital value. This is just in terms of cash flow. It's sort of, they should have rented this property out for 3 months, but it was vacant. And every month they're losing that potential rent, which they've also still got to pay all the costs ongoing, right? So all the insurance and maintenance, etc.
Yeah, exactly. So, like, for example, just having a look at the figures for what would have been the January figures, there's just little places that you wouldn't necessarily think about or come up very often. One that I don't think has got anything to do with high density stuff is South Ripley in Queensland, which is kind of just like southwest from from Ipswich by about probably 5-6 kilometres. Now, this, if you look at it on a map, it's all kind of just green, right? But it just sort of goes to show that there are these little communities that pop up there that can have these sort of short-term supply issues where there's just a lot of property that's coming on the market straight away. And as you guys would know, there are a couple of buyers agencies, or, they might be, let's just say they're house and land style channel agents that plug into 1,000 accountants and financial planners. They're flogging these things off the plan. They all hit the market at once. You've just got this huge competition for that area. And some of these organisations are big enough that they can just massively influence local markets. There's almost like an announcement effect. So those are the times where I kind of see things pop up in the index and I have to go to Google because I'm not sure where South Ripley is. Yeah.
What's that?
And that I'm seeing a little bit more. There was another one that popped up not too far from Geelong, not that far ago. So I think that's a cautionary tale. A lot of investors are electing to buy new. When we started looking at that in our data, we were sort of seeing around about 34% of people were buying new in 2013. 2017, it was like 49.5%.
Yeah.
And it's not just units, although units have become a little bit less popular in the last 4 or 5 years, but new property, there's always a bit of a red flag on it for me, whether it's house and land package or whether it's a high-rise development. You've just got to be careful about what's coming on at the market on the market at that time, and scarcity. You want scarcity in an investment property.
Yeah. So, I mean, there's one out near you, Mike. I mean, you're up in Newcastle way, aren't you? Yes.
Yes.
Yeah. I mean, out near sort of Maitland, East Maitland, there's this little period where I had a few clients all wanting to buy in the middle of, when I grew up in Newcastle, and I'm like, that's nowhere near the city. And they all thought it was, commutable and not that far from the city. And I'm like, that's a long way. Yeah. And it's the middle of nowhere. And if you have a look at the satellite, you can see it's just, farmland.
Yes.
And that's the thing, they've got the advice that this is the location, this is the story, and then they don't go and do the due diligence and just bring it up on the satellite and think things through. Yeah. But you're right, because they get 50, 100 houses that they get built from a builder. They make a massive margin on them, and then those 50 or 100 sort of houses all hit the rental market at the same time, and then everyone's like, well, I don't want to rent out here.
Yeah.
And then they just sit there vacant. And so those would be a lot of losses because, as a percentage, they all add up. So that doesn't surprise me. There's these little, danger zones and pockets that pop up where investor spruikers have caused some damage.
I love the fact we've got a quantity surveyor here. Somebody actually sort of effectively makes a living calculating people's depreciation for tax. And as we all know, the brand new stuff gets the maximum amount of depreciation benefits for those investors. And I use the word investors quite loosely here. So I love the fact that you've said don't buy brand new, even though for you it means more work.
Yeah.
But I think that where was I going now? I've totally forgotten. I just realised my phone was not on silent, so I got distracted in the middle of my question. Hang on.
That's all right.
Oh,
is it $10 cost for every edit?
No, yeah. What's interesting to distinguish though is your rental loss index isn't around the the capital. What do you call it? Hang on. What's interesting to distinguish though is your rental loss index is around the vacancy and what that vacancy costs people in that area on those median rents, right? As opposed to losing money so you can negatively gear. So it's a totally different concept of loss in terms of property. And we could do, and we have done many times, talked about negative gearing and why that is not a reason to buy a property. It's just a nice little benefit if it so happens that your cash flow doesn't actually cover the cost of owning that property in the short term.
But vacancy is a real risk, right? So it is something that you should really be thinking about it. And clients will come to me and they'll say, I can understand their thinking, and so it makes sense. Like, this property would be easy to rent, so I'm going to buy it because it's easy to rent. Generally speaking, it's not that easy to rent, to be honest. When you break it down, you look at the property they're going to buy and you look what's on the market. Maybe they wouldn't mind renting it and they think it's cheap and things like that, but those are usually the cheaper ones, the more affordable ones, the newer ones are the hardest ones to rent.
I think it's easy because it's got a new kitchen.
Well, there's
a toilet
a sort
nobody's sat on.
Yeah, there's a fallacy there that they think it's easy to rent. So I'd sort of break that apart. So I'd do a quick search and say, well, there's 500 of those to rent right now. So I don't think it's that easy to rent them. They've been on the market for 3 or 4 weeks. But my belief is that a good quality asset is actually very hard to buy, but it's actually also very hard to rent. And so you shouldn't ever have good assets will also have no problems with vacancy. If anything, whenever your tenant decides to leave, and every property shouldn't have problems with vacancy, good properties, because you can always drop your rent, So maybe you've been able to increase your rent because when you listed it, it was a perfect time and you got this really big offer. But, a good asset doesn't really ever have a problem with vacancy. It usually gets a better tenant, because it's usually a bit more expensive and there's usually scarcity there and you can pick and choose who you want. And so it's not a reason to buy a property because you think it's easy to rent, but good assets usually have no problem renting. And, because the tenants stay a long time as well. They're like, well, why would I move out of this place? This is amazing. If I try to rent something else, I look online, I can't see anything as good as what I'm renting. I'm just going to stay here. There's no point upsetting the card. So, Yeah, I think vacancy, tracking that and making people more aware of that is a really interesting thing, because they actually are real losses. The income they should have been getting, then they've got to pay maintenance. And this is another problem I see with people going down the quantity strategy. Maintenance it's got a lot of money on smaller and cheaper properties, isn't it, Mike? To fix the tap or, change the toilet or, that's quite, similar across, if it's a cheap asset or it's an expensive asset. Maintenance can really kill you on, the cheaper properties.
Yeah, and some awesome points there, Chris. I think maintenance is one of those things people get sort of excited sometimes because it's an instant write-off. You can claim 100% of it in the first year, but you've still got to have the money in your pocket. People don't kind of necessarily realise. And, people do buy properties because the depreciation is solid. As much as I've spent 10 or 15 years saying not to do that, and I probably love depreciation more than anyone else in the world, it's not a reason to buy. And by the same token, vacancies isn't necessarily the sole reason to buy, but there's a solid correlation that if it's in demand by renters, it's going to be in an area where there's demand for owner-occupiers and other investors, so the property should go up in value. So if your rental loss index is 6 and there's another place that's maybe 4, I'm not saying buy the one that's 4, because the capital growth has got to be factored in, right? Like there could be some variance to it. But I do think it's an important little part of the checklist to just understand it, because it is a cash flow loss. You do actually have to make that up somewhere, somehow. A property that rises 8% in a year compared to one that rises 6% in a year, that doesn't involve you putting your hand in your pocket for that 2%, but the rent absolutely does.
Mm.
And I think where it's really prolific is obviously the commercial market. We're going to do an episode on that in a few weeks, but the vacancy in commercial market, to fill that, could be a lot of money. You've got issues with banks, potentially reviewing your loans. The whole value of it is based on your lease, etc. And so it's something you really need to be aware of, if you've got commercial, because you could have bought it with a 5-year lease and it could have been a great investment. You could have paid a premium for it because it was got all these rent increases in the contract, and then your tenant leaves at the end of it, and if you've got vacancy, that whole asset gets revalued. And so vacancy is a huge issue in the commercial market.
Yeah, it's a much bigger one, isn't it? Because there's always a demand for people with a place that they need to live, but whole industries can decide to outsource or go online or shrink or something. So that's why there's that risk reward difference, right? You typically get a lot higher yields on commercial, but it's a double-edged sword sometimes.
Yeah. And I think, I'm often having an argument with people about cash flow versus capital growth when it comes to residential property. But the reality is, like Chris said, cash flow is important, and people do need to be across the cash flow. And so therefore you don't want high vacancy rates. But also I think and I've said it many times, that unfortunately residential property investing is really, it is a rich person's sport, rightly or wrongly. The fact is that if you go and buy cheap assets that are risky, often it doesn't pay off, for the person that's trying to make themselves wealthy through property. So it's a tough one, because in order to buy that high quality asset, you're going to need the cash flow from your income to be able to support that asset for the period of time until it actually does get to become cash flow neutral and move into positive. But that can take 10 years if it's a good asset in a really good area. So it is a challenge. You do want it rented out, though.
Yeah. Well, the big danger for investors right now is that they can't afford to do the upgrade, or they can't afford even to buy their first home, because they don't want to, for example, change their lifestyle, or maybe they can't easily with their work and their opportunities and their family, etc. So they're forced to rent long term, and this will, a big price rise of the property increases that, and they go, well, I've got this money in the bank, I need to get it working. And then they start looking to investments, and they potentially don't want to spend a lot of money on the investment because maybe they want to upgrade their home one day and they don't want to use it all, and don't want to have a huge mortgage and just want it to cover itself and to be positively geared, etc. And so I think it's a real.
Tanny if I buy a really expensive one.
Yeah, well, that's it. And we can already see that, just through new people coming to us and, what they're thinking about doing and how we reframe their thinking and, talk about maybe they should just focus on that home like we did today with a client, dragged them back to the strategy because they all sort of got that money burning in their pocket. They've been looking for a couple of years, and they're just starting to go and want to invest the money. So it's a real issue at the moment.
Have you got a property dumbo for us, Mike?
Oh, yeah. Look, I think that chappie who had the policy, his last name was Dick. I always remember that because there's a correlation between the sort of thought process for that land tax policy and his surname. He was the guy that was talking about adjusting the land tax calculation in Queensland to include land that you have exposure to in other states. I think when we've got a national rental affordability crisis and record low vacancy rates, Queensland is sort of saying investors, we don't really want your business here is a bad move. Now, I'd love to think that the government is going to step in, and investors aren't the only ones that can provide this accommodation, but it's just traditionally not been the case. They don't own anywhere near enough stock to make any difference. So I think that was a dick of a policy from a chap named Dick.
I agree.
I mean, the land tax issues and changes, there's lots that needs to change there, right? In terms of encouraging more investors and, because this is what's going to cause it, solve a rental crisis. But, there are potential changes of land tax stamp duty to land tax in New South Wales. It's sort of been forgotten about over the last 12 months. If those things happen, that would be a huge thing for demand. So I think it's any changes to these policies is good to be sort of being across. Oh,
it's a good discussion piece, and I should be fair to him. I don't think that's necessarily a good idea in the current market. The conversation about whether it should be an annual subscription-based land tax or an upfront one, I think it's a great idea to get out there to consultation. There's some really good positives to it in freeing up the little old ladies to downsize and that sort of thing. So I'm always happy for there to be a discussion about how to make it more efficient.
Awesome, Mike. So good to have you on. It's a big issue with the building costs, and it's enlightening to sort of see what's happening with the vacancies, I guess, because they're real losses for people. So thanks for coming on, Mike.
Pleasure, mate, as always. And thanks, Veronica. And if you need a swimming pool, get in touch.
You're going to set up a side business, are you?
Yeah, I'm just going to take a sweet little 15% off the top and it's all yours.
If you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or North Shore, my team and I can help you buy without regrets. Reach out via my website, gooddeeds.com.au.
If you're looking to buy your first home, thinking of upgrading into a new one, or purchasing an investment property anywhere in Australia, my team love to carefully guide you on this journey. And most importantly, get the finance right. Reach out via our website, wealthful.com.au.
Thanks for joining us. We'd love to see you again.
And remember, don't be a dumbo.